Greetings from our team at Robare and Jones Wealth Management. My name is Jack Jones. I wanted to share some insight with you. We are during the week following the election, and I won't add much to what's already being discussed and well known regarding the election. But it is worth noting that last week during an election year, the market had its best year since 1932. So it's interesting amidst all the talk about elevated risks in elections that, again, the market last year, best week during an election year since 1932. There are different reasons offered for this. One is that we're closer to the end of the election process than we are having it in front of us. Also that it's likely at this point that we'll have divided government going forward, although that's still not completely determined, likely to be determined by a Georgia runoff in January. Some additional thoughts that we wanted to share with you briefly. First of all, we want to wish all veterans a very happy Veterans Day, not only wishing you a happy Veterans Day, but thanking you for your service. And we're reminded in weeks like last week where we're in a divided country, and there's a lot of things that we take for granted, and the freedoms that we have that so many fought for is certainly one that we're thankful for. So thank you to all veterans, including my U.S. Air Force veteran father. So we asked this question, is a negative October good for stocks? Not in October, but what does that look like going forward? Well, you know that we had a negative October down almost 3%. 1 year after a negative October, and this goes all the way back to 1926, on average, you're up 14.5%. 1 year after a positive October, up 10. So what this just means, this doesn't mean this will happen this time, of course, but that negative Octobers are usually good for stock market performance going out 12 months. This is interesting as we think about elections, that as we look at the different parts of the market that have benefited under recent presidents, this covers 4 of them, that during Obama and Trump, the same 3 sectors, albeit in different orders, did the best over both elections. So you had Obama's top 3 sectors of the market in consumer discretionary, technology, and healthcare. The same 3, although in reverse order, with technology being in the top. And interestingly, although the 2 presidents don't have a lot in common, one thing that they do have in common is that energy as a sector was the worst performing during both administrations as of this point. So we continue to look at interest rates, and interest rates affect, the risk-free rate affects the price in terms of valuations of every other asset. And as many of you well know, we've talked about rates a lot, where we climb this mountain of interest rates, getting to, if you had an early 80s mortgage, you probably had it at 15, 16%, all the way down to, we closed the month of October at 86 basis points. Now, interestingly, as this recording, rates have moved up a bit, and that's something that we're paying careful and close attention to. But yield and return being hard to come by in bonds affects the outlook of equities in terms of valuations overall. And then volatility. Interesting, in 2019, we only saw 7 days where the S&P traded plus minus 2%. As of mid-year, and this is mid-year only, we're on pace for 56 plus or minus 2% days. So a lot of volatility thus far this year. We talked in prior updates that we got to a bear market and out of a bear market, both the quickest time in history earlier this year. Markets have settled down a bit of late, but we've had a lot of volatility this year. And then a look as we look to the back half of the year, the last 2 months. On average, what the S&P has done in election years versus all years, the month of November is basically the same, and also in December. So in spite of elevated risk discussions as it relates to different election year outcomes, in essence, the S&P 500 has done the same in November and December in election years versus in all years. So hopefully that's been a useful input. Again, we wanted to keep that brief. We want to wish you all the very best. To our clients, we thank you for the trust and confidence that you place in us. So we look forward to gathering in office and in client events in the very near future. Until we see you again, stay well and take care.